Let's get now instant reaction from our fast money friend, Gene Munster. Of course, he runs Loop, a venture capital firm. Gene, we're going to have you on, and still are, by the way, to talk about a lot of the stuff that was going on before this breaking news. But you just heard it. Subpoenas. America cares. Should investors care?
Brian, I don't think so. I feel like I've heard this story before. There's a healthy dose of deja vu. And at the end of the day, I think most investors have become numb to what Capitol Hill is doing against some of these big tech companies. This is just the latest rev. And when we think about the companies that are noted in particular, a couple things stood out. One is feel like I've heard this before, and investors ultimately shrug these off. Second is notably absent from that list. I don't think Apple was on there. Maybe I missed that, but it felt like it was more related to the social media platforms. And I think that's a testimony to how Apple's navigated successfully around what's been going on in Capitol Hill. But when you focus on the social side, these companies, we think about Facebook, Meta, you think about what Snapchat's doing. Ultimately, I think it's a lot less about what's going on with subpoenas in Capitol Hill, and what's going to be more important when they report their December quarter is what engagement numbers are. And just as a quick recap, what the state of engagement was with these companies, Facebook was, they grew their daily active users by 6% in the September quarter. That compared to 7% growth in the June quarter. They've been growing at that 6 to 10% range for the past 4 years. And when you look at Snapchat, even though they had some negative commentary regarding IDFA and some of the Apple changes, they grew their monthly active, their daily active user by 25%. You put it together, I think the DAU numbers ultimately are what investors are going to care about with these companies over the next few weeks, and less about what's going on in Capitol Hill.
All right, let's get back now to the reason you are here, and that is some of the troubles in tech land. And I want to make sure that our viewers know that we have a sense of context. Okay, Gene? Because I get it, stocks are down a couple of percent. All right, yeah. I'm old enough to remember when a 10% down move was not that big of a deal. Still, we're dealing with a generation of new traders. They really haven't had to deal with this. Of course, outside of the pandemic-led drop-off in 2020, that was kind of its own exogenous event. Let's not forget, from September to December of 2019, the Nasdaq fell 22%, and it ultimately was a buy. What's your take on the macro move that we are starting to see in these markets? Buying opportunity or not yet?
Not yet. I think I would generally echo some of the same commentary from the traders today. I think that there's still some downside, and of course, especially with these higher multiple companies. And the way I would assess it is kind of making a very strong line between the near term, the next 3 months, and the long term beyond 3 months. And in the near term, what I see going on is a game of Fed roulette, and this creates investor anxiety. You're right. I remember those days, those 10% down, but down 2.5%. That is a 2 standard deviation move. Those are they are less. They don't happen very often. And of course, fear creates more fear. And then the question for me, what it comes down to answer your question: at what point do we get through this? At what point do people start? Can they be more aggressive? I think that there just needs to be a simple resetting of expectations from the Fed. As I mentioned, this Fed roulette, it happens. There's a direct correlation between somebody from the Fed talks and the market goes down. And what I'm hearing there is investors are saying, I don't know what the Fed is going to do. And we know inflation is bad. We've established that. And at some level, the Fed needs to take control here. They need to give investors a clear direction of what they're doing. And I know they're not operating in a perfect environment. But if they would just say, we're going to raise it 4 times, and guess what? We're going to make that first raise 50 basis points. The market would be down 5% on that, but then I think it would be done. At least we would know. And in this point, the worst thing that the Fed can do at the end of the month is to say Omicron, and Omicron is bad, don't get me wrong, but if they just kind of play this off like we can't make any decisions now, that would be a disaster, I think, to the market. And ultimately, I think the market needs its medicine, and that's what I'm hoping will finally get this cloud to clear.
So, Gene, what I hear you saying is this is a rate environment that ultimately mega cap tech can tolerate. I believe that. Again, the kind of rate move I think we can get out of the Fed in the near term or should expect. So what do you do as an analyst? We can judge what this means in terms of asset flows and passive markets, and we do that every day because of the weighting of these stocks. But how about a 20 to 50 basis point move to the valuations of these stocks? Tell the audience what that means to you as an analyst.
So every 1% change in the Fed fund rates typically impacts the valuation by 10 to 20% for these companies. And so, there's a projected 1.5%, 2% move. It is a measurable impact. And so that is part of the reason why I said we're not through this, is we still need to digest those changes. If we can get clarity about where the rates are going, then the market can identify that and can move on. But that's, Tim, to answer your question, is that's the impact. I would say that if there was somebody who was more optimistic, at least over the next few weeks than I would, they would argue that that's true, that dynamic is true about the 1% impact. But they would argue that that you're going to see this inflationary pressures are going to create upside to earnings that will offset that 10 to 20% headwind. And so you do have an environment. We think about how strong Facebook and Google's business was last year. A lot of that was ad pricing that went up because of inflation. They're going to benefit from these. And so, unfortunately, from a fundamental perspective, there's a lot of conflicting data.
Gene, repeat that. I think is really important what you just said. Every 1% move, which would be 4 rate hikes, assuming they're a quarter point each, takes 10% off of valuation?
10 to 20. Now, we've seen some of this. Nasdaq's 6% off, but if you assume we go to a 1.5% Fed funds rate, that would assume there's another 5 to 10% downside to the Nasdaq.
Gene Munster, Loop, really important stuff there. Gene, we do appreciate that. So,
Thank
Guy
you,
Adami, I mean, I'm not that good at math, but thank you. Guy, I'm not that great at math, but you think about it. If Gene's right in the history, let's say you got a stock 30 times earnings, okay, we raise Fed funds by 1%, or the market thinks we will because they're going to act before the Fed actually does it, so that's 10 to 20%, 3 to 6. So you take the stock down to, say, a 26 times earnings instead of 30 times earnings. I wonder if it's that rational.
I think it is that rational. Now, it won't feel rational, and we speak about this all the time. Pete talks about this too. I mean, it never, on the way down, everybody's hoping for lower prices to buy things cheaper, and they'll always say it, I wish I could buy X at this price. But then when it happens, it's never for the reasons that you thought that would get you there, if that makes sense, and you become petrified. But if you have a plan in place, this becomes very rational, and to your point, it is just a math problem. And I think everything Gene just laid out, we all should want, because it's going to bring things back to a normalcy level where you can start to, gauge what is right and what's wrong in terms of stocks. Quickly, in terms of Microsoft, you go back and look at the move, and Pete talked about this, as did Karen. Yeah, that move from 349 or so to this level has been drastic. But if you look at where we are, we're at huge support levels. We're at a prior all-time high from literally this fall. So there are stocks that have given back enough where they might make sense right here.